Are you fully up to speed on the potential upside from this multifamily boom that we're starting to experience by understanding really the fundamentals of the multifamily industry going into 2025? That's what we're going to be doing today on the Gray Report, digging into the fundamentals of a piece from Cushman & Wakefield on unpacking multifamily supply risks and demand booms, but also looking at affordability, a piece from the Harvard Joint Center for Housing Studies on affordability challenges and the composition of middle-income renters, and then a piece from Moody's Analytics. Americans need more affordable housing, not just Class A inventory. I'll take Class A inventory at a discount right now if I can get it. But then more reactions from last week's decrease of the Fed funds rate by the Federal Reserve. The commercial real estate industry is still feeling the shockwaves, and how much has been priced in, and where will prices go before the end of this year and as we get into 2025. You want to stick around for the entire episode of the Gray Report. Make sure you're subscribed to the Gray Capital YouTube channel, because if you're an active investor or passive, this is the one spot that every single week we're breaking down all the latest research reports, data, articles, and throwing out some original opinions on the multifamily industry, commercial real estate, residential real estate, and taking a look at the macro economy. So strap in, get ready. We've got a great episode. Let's get into it. Welcome back to the report, everyone. Joined again by producer and director of communications and marketing here at Gray Capital, Dr. Matt Bosnagel.
Hello.
Matt, great slate of articles, really talking about the Fed, talking about some of the fundamentals, affordability. Last week's we did a live stream episode watching the Fed announcement press conference. Jay Reeder, Chief Investment Officer here at Gray Capital, sat in for me, did a great job as well. Go watch that video. If you missed last week, get just the real-time reaction as that announcement was made. But we're still feeling the shockwaves. Obviously, it's going to take some time to fully realize the effect of the beginning of the rate cutting cycle, because that's really what it is. It's more ceremonial in a way. I mean, like the rates did decline, the Fed funds rates. Now the 10-year has popped up a little bit in recent days, but it's really more hearkening in of a new era. What that era is going to look like.
Because so much stuff was priced in, and there were this kind of anticipation, let alone leaks about what was going to happen.
Yeah.
So
we've been covering interest rates, Matt, basically on a weekly. I mean, there are weeks that we take off from talking about interest rates and inflation. We talk about inflation a little bit less now. Yeah. But man, I mean, it has finally come. My prediction for the rate cuts taking place in January, officially incorrect.
Well, it's good to be wrong sometimes.
I kind of felt like I was. I think that was part of the reasoning behind it. Is it's like no, just kick it out. Just kick it out as far as possible, and then I won't be disappointed. So we got it in September. 50 basis points decline in the Fed funds rate. There's talking of an additional maybe 225 basis points cuts before the end of the year. We'll see how things go. Jerome Powell saying the economy is kind of fine. We're doing just fine. It's fine. We're not in a recession right now.
What was the quote from it? It was like, we are doing basic job-like things or something like that. Or
I think something like that. But at least right now, there's no absolute sirens going off. Yeah. But we do have a slowing economy. Everyone's looking at the jobs reports that are coming out. Are we still hiring? Are we going to be slipping? Because as we are entering this cycle of rates coming down and the yield curve is reinverting, from a technical standpoint, it's not crazy to see a recession, in the coming months, but there's really no specific data that is pointing to a recession. Maybe a slowing down and normalization, but man, it's on the top of everybody's mind. That's for sure.
and you'll see in I think it's the Cushman & Wakefield article about the Fed, is how cap rates tend to trail they don't coincide. It's not completely instantaneous, right? And I think that the same thing could be said for businesses. There's a lag period. Sometimes it's 6 months. Sometimes it's like a year and a half or so before the economy really kicks back in and starts to kind of react to that.
And just because I think that's a really good point, that there's that lag effect. And I also think that there's going to be a little bit of volatility and I think we're going to be welcoming some price discovery. We're seeing more properties come to market. I anticipate that the first and second quarter, especially the second quarter of 2025, are going to be huge for multifamily sales volumes. I think there's a lot of properties that are going to come to market at NMHC. They're going to be brought to the Multifamily Housing Council's annual meeting in Las Vegas at the end of January. It's often the time where deals get rolled out. Right now, it's a little bit of an awkward time to take a deal out to market. People are doing it. People have done it. But, like we've talked about a lot on the show, man, it takes a long time to identify a deal, underwrite it, negotiate it, put it under contract, do due diligence, keep the loan in place.
Yeah.
It can take 90, 120 days. I mean, hopefully you try to do it in 60, but, again, that's contract to close maybe in an ideal scenario, not all the rest of stuff else that goes with it. So to get that done before the end of the year with, again, there aren't great excuses. It's just the reality, but, Thanksgiving and holidays and all the rest, it's just New Year's. Who wants to be closing? It's like, we'll close, we'll close the week between Christmas and New Year's. Again, happens all the time, but don't want to be doing it. And it's not that you don't want to work. Good luck getting everybody else to work, on December 20.
So like the deals that came to market in the past month, those are probably the last ones of the year, more or less.
Probably. I mean, there will be some folks that will want to move quick. Some sellers who will be wanting to move quick, and they'll accept a lower price. But what also we're seeing happen, which I think we talk about cap rates move slow and real estate moves slow. It wouldn't shock me if we see cap rates move really far. There are some transactions that take place in Q4 of surprisingly low cap rates. Because there is so much money that has been on the sidelines that has been earmarked to be deployed, and they're like, hey, we got to buy something, and everyone's looking for the nicest asset. So there's all the capital is chasing. Even if there are a handful of properties on the market, they're chasing the nicest.
I completely agree. That was my not pessimistic, but my kind of cynical, realistic take is that investors get so excited by this interest rate news. They would jump into the market, and prices would still kind of stay up. I mean, that's kind of what's going to happen in the housing market. It's not like housing prices are going to go down.
Why would they?
Yeah.
I mean, why would they? And so what'll be interesting to see is, again, we'll see some we are getting ready to see a bunch of sub 5 cap acquisitions. All right. But what I'm curious in seeing is, as long as the 10-year treasury still stays kind of at a high 3% range, and the Fed funds rate is generally mid high 4s, you still need somewhat of a spread. And so a sub 5 cap deal right now for me is it's pretty hard to pencil unless you've got an aggressive value add strategy. There's quite a story. Most deals, I think, still are wanting to trade around kind of a 5 cap, the 5.5 cap, and again, maybe a little bit under if there's a very compelling story. Then because then you've got this whole part of the industry right now that's like, no, we're not going to buy anything other than a 6 cap.
Yeah, well, if you want to look at this Cushman and Wakefield article, they put it out also very, very soon after the the article from. I'm sorry, the announcement from the Fed too. So they had prepared, but you do get a sense at how slow moving actually cap rates are. I think that there could be momentary volatility, but all in all, cap rates take slower maybe than the interest rate movement itself.
Oh yeah.
So we could at least see a more favorable spread for investors momentarily. However, I do think that cap rates are going to come down to close that quicker than normal.
What I'm talking about is a potential moment before
I know.
I almost think that there'll be a transient much lower cap rate as there's a demand is unleashed, all this equity that's going to be looking for a home maybe before the end of the year, and then I believe that we'll start seeing things normalize and cap rates come back up as people are like, that's too crazy, rates are still high, and then they'll gradually get back down. But
I'm a big fan of that kind of momentary fervor that it's just unavoidable.
And then it's like, that doesn't make any sense. That doesn't make any sense.
And because also there's been so much pent up demand for the past 2 years amongst investors who got a taste of it, for 2 years, then they got to nothing for the next 2 years.
Because there's still a lot of supply coming online, right? And rent growth isn't going to be crazy in 2025, so you're going to have of owners, and buyers who are going to be looking at deals, and they're going to say, "Look, I haven't had any rent growth for the last year and a half. I can't get I can't get that aggressive."
Yeah.
Even though you could say, that would mean that probably we're going to see some rent growth, coming up, especially as we've talked about, supply is going to really slow down. But we're fighting the last war, and so let's maintain occupancy. And
Yeah.
I have a hard time seeing people being aggressive on their underwriting to justify much higher purchases.
This is what's
year.
interesting too, is like, knowing the dynamics of rent growth in the past like 4 years, right? There was super high rents that almost kind of seemed to probably inflate prices if you're going off a T12. But now we're going from like a year and a half to 2 years of very low rent growth, where the property may be a little bit more than the income says. But that's I don't know.
Well, no, that's you always try to buy these properties based on their income, their NOI, how much income they're producing. But sometimes people are buying them there's always a degree of speculation.
Yeah.
Someone's like, "Oh, only buying actuals." Yeah, you need to base your offer on actuals, but you have to have some business plan. You have to have some idea of what we're going to do with this property. Why do I think it's going to be more valuable? And the speculation is where you're speculating if you just say, "Well, I just think it's going to be more valuable in the future because the market's going to appreciate." You could be right, and that could be part of your business plan.
Yeah.
But there should be something else behind it. Now, and I'm even okay saying the specific growth in this submarket, if you're using some data to back it up,
Yeah.
like there is no new construction that can take place for whatever reason, and there's going to be X amount of demand, and we're going to be able to meet that demand. Therefore, we're going to see some rents go up. Okay, there's at least a story there. But if you're just buying it saying, prices go up,
Yeah.
you know,
Yeah. It's just is interesting how we've seen such a swing in incomes, and I would, I don't think that rent growth is going to be near zero next year. I think it'll be a little bit more positive, but the T12 would say otherwise.
But I think that everyone, including us, is going to be very hesitant to say, "Oh, it's going to be a gangbuster year for rent growth," until we see it. And then once you see it, it's going to be too late, because by the time you find your deal, you're going to have 3 or 4 months of good rent growth, and then the story's going to be out, and everyone's going to be buying on T3.
Yeah.
All of a sudden, and not be that's what's going to be frustrating, is because you look at a T12 and if you see flat or negative rent growth, and then the last 3 months though it's been cranking. Well, I want to buy, and so from a seller's point of view, they're like, "Hey, no, but you're buying. This is the performance today. The last 3 months, that's more indicative of the future than the last 12 months."
Yeah.
And then, but the buyer says, "Okay, great, you've had 3 good months."
Yeah.
But like, what if you just gave everybody a concession? What if what if you manipulated the performance somehow? You spent an ungodly amount on marketing that you somehow capitalized, and we're not going to be able to do that in the future. Or you ran the property with no people. Yeah, you didn't have any expenses. I can't do that forever. So it's all nuance. That's where you have to be careful, and you have to have some experience, and use his history and buy on actuals, but then also know how you're going to operate it and what you can do with it.
Yeah. If you want to stay on this Cushman and Wakefield article,
let's stay.
We can kind of use this as a bunch of different takes on the Fed, as Spencer noted earlier at the top of the show. A lot of time to digest, but it's been a week, and largely this kind of stuff that I've been reading here agrees with our initial takes that were just momentarily afterwards, probably because we knew a lot of people knew it was coming. Cushman & Wakefield, though, reminds, just as you were kind of saying, like, things aren't going to improve instantaneously. The quote here from them is, "Despite the cut, monetary policy remains restrictive to economic growth." And they say the sweet spot really is 2.5% to 3% for a neutral, no inflation, no bad employment. So that's where they want, and that's, I mean, look, we've got 200 basis points to go from there. That's a little bit of a bummer of an assessment, and they make some references to, like, "Oh, don't worry, there's signals. This rate cut does signal better days."
Well, it also, in perspective, because we see it as like, "Oh, the economy must be bad because they had to decrease rates," but the reality is, like, forget where rates were. Are we in a restrictive monetary policy stance, or if we are, encouraging economic growth, and we're still restrictive.
Yeah,
So,
yeah.
if the Fed really thought the economy was going off the cliff, they would bring into more of like an easing policy, a level below, much further
Yeah,
below
yeah.
neutral.
Ultimately, they're referencing a lot of people are referencing dry powder moving off the sidelines, bigger investors, major investors. I think they are, but that's going to be a little bit slower moving and not instantaneous. And they did post a modest yet promising 3.5% increase in investment sales. So we've stopped falling. Investment sales are starting to pick up materially. It's 3.5%. I think there's going to be more to go. I'm not waiting for institutions to move off the sidelines at a huge clip. I think that there's a lot of dry powder that stays dry, seems like, for a long time. But it's interesting to return back to that graph. Is given the slower speed of CRE price discovery and the time it takes for a deal to close, counting on a lag period between price discovery, and a lag period between interest rates going down and CRE going down, that you may not even get that may not be actionable. Like it's a lag because it takes a long time to get this deal done. So you can't just say, oh, don't worry, it's going to be slow. I'll wait till things really pick up, because like you said, it's going to be too late. So you have to start making decisions 3 months ahead of time, because that's how long a deal is going to take, if not longer. I do want to note, this is what they said. Fed cutting cycle signals pricing inflection ahead. When I was making my notes, I was like, man, that's a paragraph in and of itself. They close with this graph. They could have written a whole paragraph or 2 or 3 on that, because there is a pricing inflection ahead, and it's going to be interesting what the timing of it, because it's not guaranteed. Like I said, it's not going to go down instantaneously, but my guess is it actually does go down a lot quicker than it has in the past. In the past, maybe a year, but now maybe it could be 6 months.
Cap rates?
Yeah.
Yeah, I kind of agree. I think that we just talked about how that this initial push has already brought cap rates down, and maybe they stay lower, and maybe just the market is more efficient, and it was more primed of where it's typically more of organic pressure, compression or expansion of cap rates. Related to long-term fundamentals and kind of long-term expectations of interest rates, where this was a much more powerful kind of event that took place, in kind of a marker, in a signal to the market that the market, again, was just really primed to receive.
Yeah. I agree. We can run through other.
Yeah, let's keep running through.
Okay, so we can go to CBRE. That was at the top of mine. It's really brief. They came up with this little short report on the day of the rate cut, and I think it reflects what's really a tight ship that they run at CBRE. They really had their stuff. They put it out, and then and they make some pretty straightforward calls. The quote here that's relevant is. They say the Fed indicated that it expects an additional 50 basis point cut in cuts this year and 100 basis points in 2025. The forthcoming rate cuts, coupled with lower bond yields, will bolster commercial real estate investment activity and asset values. CBRE predicts a 5% increase in annual investment activity this year, with further acceleration next year. So they make solid numerical claim. We're going to see more, as evidenced by the 3.5% that was in Q2, as noticed that Cushman noticed. I don't think that a 5% uptake by the end of the year is uncalled for. We may see more. Let's hope that we see more. But I think, given the nature of the winter time and how difficult it would be to arrange a deal, maybe it'll spill over into January. But things do happen, right?
Oh yeah, no, there will be an uptick, and because it was so much of it, as you said, was priced in and anticipated. A rate cut was not surprising. The fact they did 50 basis points was not shocking, but it was surprising. But the fact that they did something, everyone had forecasted for some time. Again, the beginning of this year, 2024, there were 8 or 9 rate cuts that had been, forecasted, and obviously, I think it looks like we may get 3. But again, my call halfway through this year was we're not going to get any.
Well, and think about when we were going through the economic projections from the Fed themselves; they had the same opinion. They shifted their rate cuts basically by a full percentage point on some cases into a more positive, favorable direction for interest rates. But
True. True.
Yeah, so that's CBRE's take, and then we can move towards Fannie Mae as well if you'd like.
Yeah.
Fannie Mae is a little more, a little less of a rosy picture on the economy. They bring some attention to the larger economic effects and the impacts that it would have on the housing market in general. Really, they say that looking beyond the third quarter, we continue to expect some slowing in consumption growth to better align with the current rate of real income growth, and interest rates for auto loans and other durable goods categories have already come down in expectation of an easing in monetary policy, which could spur some additional consumption in those categories by the end of the year. I added that thing about auto loans. It seemed like boring, but that's like the brightest of part in their economic projections here. They're really reminding people that, like Cushman did indirectly by saying, no, we're well above the neutral rate. We're still at a point right now with interest rates where they're a drag on the economy. And so that's essentially the Fannie Mae take on it, is to emphasize this weakness. In a little sunnier picture from Marcus and Millichap, which notes, and what I think is a subtle understatement. What do they say? I got to find my notes here. There's
Marcus and Millichap is usually a little more more positive.
Long-awaited cut has positive implications for commercial real estate and consumers. Pretty, I would say at least a little understated. But,
True.
But they note too. They interpret completely different. They say actually consumers have been particularly resilient in the past year. Considering the high
Record
rates.
spending coincides with cooling inflation. I mean, we have been seeing that people are still spending money.
Yeah,
Maybe
yeah.
on different things, but they're still spending money.
And they also said,
Maybe
that
not
can
on rent.
translate to, improved tenant demand, as well as higher investment activity in the event that lower borrowing costs help to, quote, reopen the yield spread relative to cap rates. So that's the take. Marcus and Millichap, you can look at it as it's a problem that the Fed is fixing by lowering the rates, or you could look at it as like, well, things are getting better and we've endured for so long. I don't know if the truth is in the middle right now, because a little bit makes me lean a little bit towards Fannie Mae's interpretation, because I'd rather guard against the bad thing
Yes,
than try to rely on the future thing. And Fannie Mae doesn't say that we're trending towards an emergency. So that's just where I would come in my own opinion. I think that we covered not every single opinion on the Fed, but I tried to collect like 3 or 4, just so people could get a general overview of what people expect. I think definitely they expect increased investment activity. I think that there's going to be a lot that's unlocked here, and we'll have to see whether people go crazy at the first thing or whether they're really watching the numbers and are only going to act when the numbers are right with interest rates.
Yeah, I mean, I think that it was stated earlier that all is good until we get a really bad piece of data, and
Yeah,
I think that, I think the state of the economy is uncertain. At least, perception is reality, and the perception of most consumers, most business owners, most market participants, regardless if you're in Wall Street or Main Street, is there's not a lot of confidence.
Yeah.
I think that there's some relief that inflation has come down, but then that sign of relief is being met with nervousness, because obviously you don't want to slow down too much.
Yeah.
And, prices are things are more expensive, but people are making more, but it doesn't feel like it, because you still remember the prices of a couple of years ago.
Yeah.
Things still seem more expensive. So no one really truly has their bearings, some more than others. If you're really watching the economy all day long, you're looking data, again, you can look at numbers and to try to convince yourself, but
Yeah.
I don't think that fully takes away kind of the emotional pulls of when you go to a restaurant and you order a $27 cheeseburger.
Oh, yeah,
and you're
yeah.
like, what has happened?
Well, even inflation, I'm thinking too, to return to like this idea that it's a continued drag on the economy and high rates, and what if that is actually the reason why businesses aren't hiring, because they've got these debt costs and they can't have their balance sheets, and they struggled not like zombie buildings or like they would be in dire straits if not for this, but really like, no, they can't afford this anymore, and they got to give you a haircut, which
Yeah, well, I think people went from labor hoarding of like, hey, we
yeah,
just need to hire people and
and
bring
then they
people
really
on
shed it. That's what I meant by
to
haircut
now, but like
firing.
people, but doesn't seem like now there have been obviously some layoffs. Tech companies and big financial service companies,
Yeah,
there have been layoffs, but it hasn't been widespread throughout the
yeah,
economy. But what I have heard is that businesses, again, they would rather not lay people off because they're like, what if we do need all these people again? And it can be hard to find people, but they're not necessarily rehiring. They're letting attrition take its
yeah,
natural
yeah,
course, and they're like, okay, you know what, you're leaving, taking another job, or you're moving. Sorry to see you go, but actually it kind of works out for us.
yeah.
And we're maybe not, maybe we're happy to see you see you go.
Yeah, yeah.
You know.
It's I just wonder. That's the thing that I've been gives me these reservations is, are we just a couple steps behind some kind of breaking point where it doesn't just lead to attrition, where it leads to firing, where things become a little less solvent. I don't think that's going to happen, but
Yeah, it's almost like I feel like there's a sense, at least I have, that it's like there's been a lot of free lunches.
Yeah.
And it's like at some point, like we know the bills come and due, and inflation was a big part of that bill, but a sense like we haven't fully paid up yet.
And what's kind of interesting too is, from our perspective in commercial real estate specifically, man, all the articles now that I read is like, oh man, after 2 years of nothing, now we're finally getting green shoots. And I think in office it's been particularly horrifying in terms of like bad values, but it's not like it's been a horror show in CRE in general for the past 2 years. So maybe it's
No.
just sales activity, yes. But
A horror show, as in like, it's a show, or the perception of everyone has been,
Yeah,
I think,
yeah.
or a lot of folks has been, yeah, maybe not horror, but I think a lot of, concern and nervousness, related to, loan maturities and, no growth, not sure about demand, just general macroeconomic, black swans that were hovering. So I think a lot of people were very nervous. I mean, if you're a broker and
yeah.
you're not doing any volume, you're not doing any deals, and you're basically just like waiting it out. Or if you're a private equity real estate company, like Great Capital is, and you're not doing, we didn't do a deal for over a year, and you need to wait for the right deal, dedicated to doing good deals. But that also means that there's not a lot of revenue coming in.
yeah.
I mean, we have recurring revenue from property management fees and things like that, but we make a lot of our fee income when we do deals. But you don't want that to be an incentive to do the wrong deal, and that's That's something like we're very actively aware of and try to incentivize around.
No, that's a good point. That's
But
a
at
lot
the
of
same
money.
time, it's fortunately, we were able to do some really nice transactions kind of prior to when things slowed down. And so we're able to kind of, fill up the reserves, and we had the ability, a lot of other companies, to kind of wait through. But if we didn't have some of those reserves, it would have been a much scarier
yeah.
time over the last year or so.
And I was
And
looking.
there were a lot of times, but still, I mean, just, being right there in the middle
Yeah.
of it, there were a lot of times where it's like, how long is this going to go on?
Yeah, yeah.
This is torture. We want to do our business, and we talked in the office a lot about our model has gone away. It's changed. The cheese has moved, and will it return? As an opinion, like probably yes. People obviously need a place to live, but are we going to be doing deals in the same way? Are the numbers going to make sense? Again, one day, almost certainly, but when is that?
Yeah.
We can't wait out 5 years. We wait out a year or two, yeah, but 5,
Yeah, yeah. No, good
probably
point.
not.
And
Not with a full team focused on looking for deals and
Yeah. well,
overhead
and
like that.
I brought up the numbers a couple weeks ago, just when I was working on the newsletter, and multifamily is still about half the sales volume as it was pre-pandemic.
Oh yeah.
Not
Yeah,
just since last year, because a lot of the stuff that we cited in the Fed reaction, they do talk about investment activity, and they're like,
Yeah.
well, year over year it was 50% less. But yeah, it was 50% less even compared to pre-pandemic, which not the boom times of 2021 and 2022,
Back in 2018,
Yeah,
2019,
2018,
normal
2019.
times.
That's exactly, it's the half
Yeah,
of that.
2020 was pretty low volume until like the first quarter was kind
Yeah,
of sort
yeah.
of normal, and then second quarter nothing happened. Third quarter a trickle, and then the fourth quarter it started picking up into 2021.
Yeah, yeah. Really,
Man, doesn't that? It's hard to. It seems like we're getting. Think about this, Matt. 2025 is around the corner.
Yeah.
It's around the corner.
Yeah.
Right. Mm-hmm. It's around the corner.
I know.
And 2020, the pandemic. That seems. Does that seem like a long time ago to you, or no?
No, it doesn't, because it's timed. It's meaningless now. It doesn't. It does seem like just yesterday, though, for sure.
It kind of does, but it's
Yeah.
almost like a full college career.
Yeah,
4 years.
for sure. Yeah, half a decade.
half of a decade.
But one thing that does
5 years.
that does it is easy to thinking back. Sure, it's easy to remember, but man, we went through so much. We went through the early fear, the fervor, and then back to back to square one, and then back to maybe getting excited. It does feel a lot like the period, kind of early in the pandemic where people were a little bit nervous, where it wasn't like complete doom had set in yet, where there was some kind of uncertainty. We'll see how it swings, but man, it wasn't too hard. I don't think on the multifamily market specifically, and that's probably where my bias is coming. All the doom and gloom.
The overall last couple of years?
Yeah, 5 years as a whole. Ultimately, multifamily investors did well. on the
Yeah,
whole.
much better than the great financial crisis. Issues, defaults were significantly higher back in the GFC.
Yeah.
Now we saw values decline this last year and a half by 20 to 30%, depending on kind of the metric that you're looking at. But again, those aren't all realized losses.
Yeah.
That's if you decided to sell if you bought at the peak and you decided to sell the next year at the bottom. But again, as we talked about, a lot of those prices are recovering relatively quickly. We're not back at 2021, 2020, early 2022 levels.
Yeah.
And not going to be there.
And frankly,
in the
I
near
think
future.
a lot of the drama, particularly in the multifamily market, probably in other sectors as well, is in certain markets, like in the Sun Belt.
Yeah, like Austin.
I could definitely see values falling off 20% just because maybe they were overpriced 20%.
But you look into some of those markets. While there still is a lot of supply coming online, the supply is there for a reason.
Yeah, and
there's
exactly.
so much demand, and
so they'll see that negative 20. They're like, no, I'm not scared at all.
But at the same time, like they have seen a lot of negative rent growth, and again, how long can you wait? And you can be right on the market, you can be right on the product type. But your timing can be wrong, and timing is it's the least. We have the least amount of control over the time of our timing, and again, you could be right on everything else, but the timing's wrong.
Yeah,
and humans are also the worst at timing.
Yeah, especially in
I don't know
a lot of times
if
you're buying a house.
If someone else has, I feel like we've gotten. I think from afar, people could say that we've done a good job of timing things, but we've never tried to time anything.
Yeah.
And so I don't know how the two exactly are correlated, but when we got back into the market, not because we said rate cuts are X amount of months out. It's because we just kind of stuck to the fundamentals and what we were looking for, and we had our price targets. And all the fundamentals made sense. It was not we need to get into the market now because interest rates are going to be down in 6 months, and then cap rates are going to move, and then we're going to refinance. You have to kind of remove time a little bit from the equation as much as you can, or to minimize it as much as you can. Really,
Good point.
That's how we've seen success. Let's talk about the fundamentals.
Let's do it. Yeah.
Cushman & Wakefield, unpacking the multifamily supply risks and demand booms.
So this report from Cushman & Wakefield has a direct connection to one that we discussed last week that I discussed with Jay about millennial homeownership, and it does cite the very same low ownership of millennials as a demand driver for the multifamily market. But I will remind our listeners, who probably and almost definitely have watched the previous episode, but for newcomers, we talked about how millennials, there were certain parts where they may be actually making some gains relative to Gen X home ownership, where perhaps now this
Don't tell Gen X that.
I know, and it could just be an artifact of the way that the graph represents age groups. It could be the case where millennials home ownership improves slightly, especially as compared to Gen X home ownership. Now they have this graph here. Now I'm glad that you saw this. So this is home ownership by age, and it is the 3/4 center moving average. This is how much home ownership has changed since 1994. In for instance, in maybe the mid 2000s, the home ownership for young people, it really spiked up really high for the under 35.
Yeah.
And then it went down. Now, my problem there is
because anybody can buy a home.
well, and also the younger people own less homes, so it's easier for them to move wildly. Now, guess what I did? I made my own graph. I made my own graph that doesn't show this change since 1994 and just shows what the rate is each year, because that chart really, again, makes that under 35. So look at the absolute value, much less of a mountain, much more of a molehill, I guess, for the under 35s.
Yeah,
but you can see the you can see the inflection point at around the pandemic kind of lockdown period, where housing and home ownership rates really shoot up really quickly, and then they kind of trend down. But you can also see that it is a rolling hill. These trends are over the period of 10 years.
People buy a home and then sell the home right away.
Jay mentioned that same thing. We looked at it in another, and you can actually, the third graph I have up here is the year-over-year household estimates for everyone. So it's kind of on average. You see that huge spike up, spike down, and then it comes back into the middle. What I think about this graph is, just looking at it, you can see that household.
This is what a transient. That's transient right there.
So this basically, I'm using this as a proxy for household formation, because this is household estimates, and I took the percent of change year over year. So basically, throughout this graph right now, the change in year over year household estimates is around 1 to 2, and it seems to change very quickly by each month. Sometimes it's around 1, sometimes it's over like 1.75, but that's basically the range that we're dealing with, is probably 1 to 1.75. And I'm saying that because it was much lower than that in the past 10 years. Like, this is as high as it's been, and I'm excluding that weird spike because that's probably just bad data. They probably just had like one guy reporting it during the pandemic.
Is that, I mean, there was a large growth, and I mean there was a 4% growth, and then the decline was it wasn't even. At first it looked even, but it was really only a 0.7% decline. So you'd think that it would have stayed slightly elevated, but
my thought is, like, if we are looking at household estimates as this driver of housing, which Cushman and Wakefield notes here, and Apartment List notes as well, is like, well, these households are growing at just about the same rate that they've grown since like 1990 almost, and maybe a little bit higher than they were in 1990. But I don't see, and also if we're looking at a general trend, I also don't see it trending downward. I think it's actually trending upward or going to plateau, and it's been higher than this, but it's in a healthy spot. I don't see anything worrying here either.
I mean, really, kind of mid 2000s, Matt, there is kind of a trend upward.
Yeah. And that may be, due to previous to that, there was a general low. So from 1985, or maybe a little before then, to kind of 2010, there was a weak declining trend, I would say.
Interesting. There these, and we're looking at this live. These like 5-year cycles. It almost seems like you can see one very clearly here and here and here, and that's a kind of a big one. But I don't know if you chunk it up to these almost 5-year household growth cycles. Is interesting, which don't necessarily. I'm sure there is some correlation that lines up with the much longer kind of housing market cycle. But yeah, it's
And
interesting.
and that may that may be the reason why we're talking about these things in terms of generations. Maybe there's a generational trends that associate with either home ownership or household formation. What Cushman and Wakefield's point in their article is that it's a very promising situation for apartment rentals, for housing in general. Man, you can really chart a growth at least for the next 10 years, if not longer, for increased demand. Or at least very steady high demand. That's one thing maybe that spike did is push. When we noted this as was happening, kind of push forward the demand. Demand stayed there. When it dropped down, it went up 4, dropped down 0.6. So
Well,
net
and
growth.
really recently, it's not the demand's fallen off.
Yeah.
I mean, in 2023, a little bit it slowed down. There's uncertainty related to interest rates, but it's much more of just the supply that's come online that has seen vacancy rates increase, occupancy decline, and rent go negative, not demand falling off. And if
Yeah.
anything, the research for this year is demand is near kind of all-time highs and,
Yeah.
and is continuing to peak. So
And I still have spent the last week, if not longer, really the past year, trying to nail down this elusive connection between high interest rates, home buying, and choosing to rent. How many people choose to rent an apartment instead of buy a home because interest rates are high? What's the numeric effect? There's got to be a way to parse the data. I've been, some people have teased it. I think there was someone from CBRE that said that they were working on a report, and I searched furiously for that. Couldn't find
well,
it.
it's almost the change in, if anybody's keeping accurate statistics of how you categorize renters by, and I haven't seen these statistics or the demographics parts this way in a while, but renters by choice versus renters by necessity.
Yeah, yeah.
And assuming that renters by choice equals someone who can afford to purchase a home, at that income, at the median, home price in that area, but they are choosing to rent an apartment versus someone who may be making a good amount of money, but is a renter by necessity. And when we say renter by necessity, especially prior to the pandemic and interest rates moving, you could think about more of like workforce housing and like a C-class apartment, but a renter by necessity might be a doctor, right out of med school that is has a decent salary, but like they don't have enough money for a down payment.
Yeah.
Maybe it's because they just buy like a BMW or something.
Or
But they don't got an option.
yeah. Well, that's a good segue as any to our next article about middle income affordability. Maybe renters by necessity. This idea that affordable housing should extend beyond classical, really affordable housing. They have that rent burden that's exorbitantly high.
You want to know what this reminds me of?
What?
So like in school, you either felt like if you were really smart, if you were like really, really smart, you got to go to the special class, you got the special attention, you go to the special math class and they're doing math that you don't understand.
Yep.
Obviously wasn't in this class. But then there's also, you can figure out where I was by this example. But then there's the people who are, the kids who are like struggling,
Yep.
Maybe a learning disability or something. They get all kinds of special attention, special classes, and someone else is going to come and like help them figure out their stuff.
Yeah.
Then you get these kids in the middle who are like, we're just kind of good enough and average.
Yeah.
And sometimes those kids, like, maybe they would be able to do some of the,
Maybe you'd see some
higher level
benefits,
math. You'd
yeah,
see
yeah.
some benefits, but some of the kids in the middle, the middle gets kind of left behind because they're like, they're doing fine. Like, we got to worry about these guys and we got to focus our attention on, wow, these outperformers. And so let's forget about the middle. And so that's what reminds me of kind of like middle income housing in terms of, they're good. They're not homeless. It's like, you're not homeless.
Yeah.
You're not living in squalor. What are you complaining about? But they're like, look, I've got 2 or 3 kids. Like, my housing has gone up. Food has gone up. Like, I'm still struggling to get by. I'm making like an okay amount of money, but still having a hard time figuring out. And then you can say, well, budgeting, and well, you can say that about a lot, about everyone else too. So what does the Harvard JCHS? What do they have?
I'll just be straight to the point. I think that their point is that middle income's not as worth it as low income. So everything else is just
So yeah, they
downhill from
so
there.
They're like, no,
Yeah,
you
yeah.
go to the back.
Yeah, they conclude that policies designed for middle income renters will disproportionately benefit groups that they define as non Hispanic, white, younger, more likely to be college educated, less likely to have a disability. And they said that these middle income housing programs would systemically reinforce racial and socioeconomic
So it's the
inequities.
racist.
I don't
They're
think,
the
I don't
racist.
think it's that. But I think that that is a long
There are
way.
more people like in the middle that are white, and
Yeah,
then
yeah.
that they're saying, not me, that more minorities or people with learning disabilities
Yep.
or Hispanic are going to be in lower income folks.
Yeah, and that's
Sounds
you know,
racist. That sounds
well,
racist
it's
to
just
me.
I regardless of how
they're the ones that are inserting race into
yeah,
this.
yeah.
No,
So
I'm
if we're
kidding,
talking,
right? It's
no, I
it's
get
serious.
it,
It's
and
serious.
and like they're yes, this is what these populations look like, and I think that
It's because they don't need the help, or they're saying, look, you're going to disenfranchise. Okay, there's the pie's only
yeah, the pie,
it's zero sum.
it's the pie one.
There's the pie's only so big, and that slice that could have gone to the family that really is in need. That again, just for whatever socioeconomic reason,
Yeah.
they're really struggling. They're only making 30,000, 25,000, 20,000, dollars a year. Why help out these folks that are making $60,000?
Yeah,
a year?
like it's between really just it could mean a house or not a house for maybe low income, or it could be a really bad house and a really bad time, or a little bit better house. I just think that that $20,000 or whatever that subsidy is that you're giving for housing for someone, or whatever that money that you're pouring into that is, it goes a lot more, it does a lot more good for the lower end than the middle income end. I don't.
I guess it depends on, and I know we're going to get into this a little bit more also, but, kind of affordable housing and, low income, middle income. There are some, the larger programs, the LIHTC, low income housing tax credit, programs, which are federal programs. That are the most common, but then local municipalities and states also have their own programs.
Yeah.
That can give incentives, tax breaks, and so all depending on how it's kind of financed or subs. Typically, it's either done through some sort of tax credits that are being awarded to like the developer or the redeveloper, and then they are taking those tax credits, which they have really no use for.
Yeah.
They're going out and selling those syndicator goes and sells those tax credits to to Bill Gates or J.P. Morgan, who buys them for 99 cents on the dollar, and they save a nominal amount on their taxes.
Yeah.
And that they take the proceeds from selling the tax credits to fund the development with provisions that this is who we're going to rent it to. But also you could just get a break on your taxes. But it's not. It's done
It's
in a
not
way
giving
like
them-
that.
it's not giving them money.
It's not
Yeah.
as though taxpayers are putting money into the
you're right, you're
treasury
right.
and we're taking that money and giving it to the developer. Now, you could say that it's money that Warren Buffett is no longer paying, or J.P. Morgan or whatever individual corporation that's buying the tax credits at a discount. Are we, it's like a loss of revenue to the treasury because they're getting these tax credits. So you could all say it nets out in a similar way, assuming that if you're going to try to make up that tax revenue somewhere else. But it is different from it's not like, it seems like they're getting hung up on a mentality, like a zero sum mentality.
Yeah.
Of like the
I
pie
agree.
can never grow. We can only, this is it. It's not going to get any bigger. And it's not to get political, but it's kind of a left wing fallacy.
It does seem like there is, I'm thinking about just the momentum that you can that happens when you create more apartment supply. And I need to dig into it's a 45-page report, and I got through the kind of the summary and the conclusions, and I need to really piece together the solutions that they mentioned, because they do a lot of comparing of the middle income and lower income benefits. But if we're talking about like rental subsidies to help people pay rent, that's going to be a lot different than subsidies to help build things.
It just you're going to build it under the condition you're going to rent to people of a certain income.
Yeah. What is interesting, and they have this in their summary, is that regionally we're looking at a similar map. If you looked at housing costs, you're going to also see the same makeup of unaffordable housing, of middle income, lower income burdens. So the rent burden is higher where it has higher housing costs. And places
like New York City.
yeah, exactly.
Yeah, or San Francisco.
Places like in the South, the Sun Belt, the West, Nevada, California, Arizona, Texas, they all stand out here with 40% middle income renters cost burden compared to states like Indiana, Ohio, and Wisconsin with under 20% of middle income. I don't think
Is it more kind of a drop in the bucket because they're, the middle class is the largest, subset of folks. There's more folks in the middle class. So it's how many of those can you help, and then how much of an impact can you make, on that group?
Yeah, that's a good question. And
it would need so many resources to move the needle on
Yep.
that demographic
Yep.
versus, well, this demographic slightly more at risk, and if we concentrate the resources, again, that could be, that may be fallacy of whether you're concentrating all the resources
honestly,
or not. But
and honestly,
we can
it's
see
like,
this difference versus we may help a nominal amount of people, but on a percentage basis, we're not really changing much. I don't know how much you're changing.
No, that made me think of something very similar. It's like they're so big that if you try to help him, if they really need helping, there's something fundamentally wrong with the way that housing is working in this economy.
Well, that's I think when it comes down to it, it's like this is all great, but it's all kind of band-aids.
Yeah.
Whereas the only real solution is you just need to have more housing.
Yeah.
And I think that what we're really talking about is another method to incentivize the building of more housing.
Yeah, because if you're targeting the majority, then you're not really targeting. You're just aiming at the average.
But it would be more politically unfeasible if you said we're going to give subsidies to build luxury apartments.
Yeah, for sure.
But so you have to call them something, because in luxury apartment, if you haven't figured out, just means new apartment.
All right, can we go to the next one, because this
Can
is
we
a perfect segue.
Can we stop calling the? I mean,
Yeah.
they all are luxury, but let's
Yeah,
let's
this
segue over.
is exactly what our next author, Nick Villa of Moody's Analytics, calls for, saying, "Man, we got to build. Can we not build B and C class? Do we have to build Class A?" I think my answer is, most part, that's all they want to build. That's all that makes sense for them. If it costs just a little bit to build a Class A than Class B or C, I'd love to speak with a developer about let's say, do you build on purpose a Class B or C, or are Class Bs just you got to wait 30 or 40 years for Class A to turn into a B and C?
That's how you build Class Cs. You build Class A, and then you wait 20 to 30 years.
And this is the fundamental.
You water it, and you
Yeah,
clean up the
I
water.
know. Yeah. Bury it in the backyard. Get a nice patina there. I think, and this is the fundamental issue.
Go to a C class apartment and try to build it again.
Well, no, and that's the point is it's a problem here because of the way there is so much demand in the B and C class areas.
Yeah.
Those buildings can't mature into B and C fast enough to keep up with that demand.
You can build a stripped down you can build a stripped down new apartment building, and you can charge a little bit less in rents, but you're not charging rents so low that you're going to
justify your building
you'll be
costs.
the lowest price new. I'm still going to call it A class because it's just new. It's just newer. You'll be the cheapest A class, but you're not going to have any amenities. It's going to be bare bones. Everyone's going to be complaining about the finish level.
Yeah.
It's going to be cheap.
Yeah.
Everyone's going to be like, these things are so cheap. Everyone already complains that the really high end luxury is really cheap.
Because I wonder. My guess is the cheapest time to upgrade to turn a B and C into an A would be while you're building it, right? It's cheap to make those improvements to make it an A.
Well, the differences are, I assume that generally the build quality is similar. It's what's the finish levels are. It's you're not cheaping out on the concrete or the foundation. It's what type of countertop, what type of cabinets, and what type of amenities. Are you a bunch of fancy light? Do you have a fancy light, or do you not have a fancy light? But the reality is, the fancy light isn't going to make it go from $2,000 to $1,000. It's going to go from $2,000 to $1,950. And so you have your crappier countertop. Okay, well, maybe it's not $1,950 anymore. Now it's $1,850. Great. So, but at the end of the day, you're not getting down to the $1,000. And so, in a developer, they're like, well, I can capitalize the fancy light and the countertop, and I get a couple $100 more for it.
Yep.
Why not?
And that's
Why
what's
not?
happened.
Why not do it?
Let's take a look at a couple graphs.
Let's look at a couple of graphs.
All right, sorry. Because that is exactly the story that these graphs show. One is a graph of how the share of apartments from 1999 till now went from 30% were Class A, just over 30%, and now a little over 50% are Class A. Because people saw those higher rents and they're like, yeah, I want that. And they build more Class A's.
Well, yeah,
Yeah.
we've built more apartments in the last 2 years or so.
Yeah, yeah.
Went through a period of not building anything.
And this is the most frustrating one. First of all, this graph has those arrows that are in it. They say Class A, asking, premium, widens. Those don't pertain to. Just ignore those, because those frustrated me.
Okay, forget the arrows.
Yeah, yeah. This is just for the viewers of the Gray Report to. But
What are we looking at here?
we are looking at the way in which the difference between the rents of a Class A unit and the rents of a Class B and C unit rose and fall over time. So 0 is 2000. So in 2001, there was a 2%. The gap between B and C and A rose by 2%. And by the end of it, so right now we are at 45%. That gap. At the very beginning, that gap was 41%. So we've increased by like
The gap between
A and B and C. Yeah. That gap has increased by 4.4%.
They are lumping B and C. They're just non-class A.
Yeah,
non-class
yeah.
A.
I would
which is
it would be a little bit more accurate if it was
It's
B,
fine.
but still.
I understand what you're doing.
But the story is, and this is what's weird. So look, we just saw the share increase from 30 to 50%. So that supply of A has increased.
Yeah,
but
exactly, yeah.
but the rent premium has also increased at the same time. I don't get it. Like there's no, I don't get it at all. And Nick Villa, who this is a really great report. It's in the Thomas La Salvia School at Moody's Analytics. Does great work. He's the head of their economics there, and he lays it out. But I still am less. I'm still asking, like, so what was it that made these rents go up relative to the lower to the higher supply? I don't. Yeah. So.
Well, I mean, they're going to deliver them at a higher rent level because it costs them more to build it.
But my basic understanding of I don't have the PhD of economics.
So that's what they're
Supply,
trying.
more
That's
supply,
what they're
where's-
trying to do.
Yeah.
But then they're saying, but then obviously they're like they can't get the leases, and so what they'll do is they'll offer a concession. Give you a $2,000 Amazon gift card if you sign the lease.
Yeah.
It's going to be a higher rent,
okay.
but like I'm going to give you some incentive, and the concession that maybe burns off, so I still
Yeah.
can show a high market rent, and then eventually they typically get those rents. But newer deliveries have struggled to get those higher rents depending on the market.
Yeah,
depending
we've
on
we've
competition.
tracked how the Class A or Class A.
But then they
have lower-
typically once they're stabilized, they typically try to get them back up there. But again, they wouldn't have been able to if there wasn't so much demand, as we were talking
and that's
about
why
earlier.
and he does note that he notes it more as a driver for builders to build more, but I think it equally works to explain the higher demand among renters is that there are more people at higher income levels that are renting. So
Yeah.
that could be this outside demand into the equation that helps to set the picture right. That helps to explain it too. I wonder though if we will see the gap shrink a little bit, because for the past few months, maybe year or so, like I've been looking at the Yardi Matrix reports, and it shows how the renters by choice are that's very low rent growth compared to the renters by necessity is a lot more robust. And strong.
Exactly, we've seen a lot of growth in the B and C.
So it's gotta make
the
sense
way
that
the
this
wages
thing
of B and C
comes down.
renters have come up, quite a bit. And as we were talking about, there's no new supply of that stuff. So there are very few. A couple years ago, 2-bedroom, 2-bath apartment in Indianapolis, $850 all day long. $900 maybe, $1,000. That's a lot of money. Today, I was looking on CoStar, average rents, across Indianapolis, nothing's under $1,000.
Yeah.
It's all $1,200,
Well,
$1,300.
And again, overlay this whole discussion with housing prices. What are you going to get per square foot for a house, and how's that changed? It's gotten a lot more expensive over the past 5 years, and that's that's got to, I talked about it earlier. That's got to affect probably a Class A demand, maybe more than others, but who knows? I do know that Jay Parsons has a new podcast. He talks about the same thing about middle income, and his point. He talks about some subsidies and stuff like that we just discussed here, and incentives to supply, right, which means government making it easy for you to buy, making it more profitable for people to build these. But he also talked about it just as like the investment prospects in general for some of these boring, like I think he said like average 16 years. They are they're middle income. They maybe you hold them for a little longer. They're a lot more stable, and he was comparing returns. It seemed like a really great idea. It's not going to be as quick as a value add that you're in there, improve it, and go out. It's a different proposition, but
it takes a different tolerance. It takes a different investor to invest in affordable housing. I think it's a great asset class. It's something that we've looked into. Like to do it at some point, but it's a different business model. It's mostly again, there's different ways to do it, but it's mostly fee oriented rather than like equity oriented. So it's like the way you look at a deal of like, I'm going to buy it for the right price, and I'm going to fix it up, I'm going to get some cash flow, and then I'm going to sell it. Affordable is like, I'm going to do a lot of work up front dealing with the government for a year or so, and then finally we'll close, and I'm going to get a big check.
Yeah.
And then we're going to build it, and then we're going to spend as least amount of money upkeeping it. This isn't what you're supposed to do. I'm just saying this is what happens.
But this is what the numbers would say, would tell you to do.
You get a management fee, and you get a very residual ownership.
Yeah.
You get half of, 0.1% or whatever. And in 15 years, it's like, okay, now you've got an opportunity to, buy the tax credit holders or the other equity out for pennies on the dollar. And while this last 15 years you haven't put any capex into it, so it's run into the ground, so people just typically sell it.
And on that podcast, they talk about and the importance of keeping it well maintained so that you avoid future issues. But
there are some great affordable owners and managers. There are also some of the worst that are affordable owners and managers that are nonprofits doing affordable housing that are like the true slumlords, or at least are maintaining or not maintaining.
Yeah, I almost like what. Could you check up on them? If I give you this subsidy and loan, then I'm going to see you every few quarters. I'm not going to tell you when I come.
Lenders do that. They're supposed to do that. They're going to probably doing it more. I've heard, Fannie Mae is much more on top of folks, or they're going to now, and especially COVID. The government didn't come show up to work for like a year or two, and now they're like, hey, we've got some problems. We've heard of some issues. We need to go. We need to get out into the field. We're like, 5 years later. Thank you.
Well, yeah, some owners.
Don't worry, everybody. The government's here to help. So it's everything's fine now.
I know, and
they're not going to ruin the housing market again, are they?
And that's the thing is like you'd really have to design this kind of system to incentivize or I don't even say regulate, to make sure that it makes money to do that preventative maintenance, to raise this quality of life instead of shaving as much as you can and relying on those government incentives to make you even more money. I mean, there's got to be a way where you keep that standard of living higher and you do the maintenance and it lasts longer and the renters are happy. But I also acknowledge it's so much work. You could get and I was just showing.
I know. Yeah, you were like so don't people want to do the work? I'm like, yes. All the people who are talking about that aren't the ones that are at the properties, managing the properties, because it is tough.
I was just showing Jay a couple of local properties that have made the trip. There's a loans to watch, and it would be some of these like to actually deliver the service that you need as a property manager. That's a lot of work. What you get it for pennies on the dollar. Let's say it's half price or a third of the price of similar units. But then what if you're spending that same amount of money to keep it up, to deal with either delinquency or anything else that may happen to improve and that it's just a lot of work. Be so many more challenges and I think it does take a special kind of breed. And I don't think that I'm not talking about like the slumlords. There's got to be a way to do it.
There's some really good companies out there that do a really good job.
Yeah. It'd be worth talking to him because I'm gonna have to look into this for sure and see what is
from Glick or Jay's got all the contacts.
Cool. All right.
We got folks.
Yeah.
I mean, Joe used to work for the Indianapolis Housing Authority.
Yeah, yeah.
Bring Joe on.
What the kind of, and I'm not talking about the limited resource pie, but like, what is the day to day? What resources do they really have, and then how do they use them? The typical, the typical issues and their typical kind of their philosophy for delivering the best care they can. Because I think that I don't want to be involved in an industry where it's
Well,
like,
this is,
yeah, we're not
and
going
this
to
is,
do great.
and we're beating around the bush. But
Yeah.
This is why like market-based systems work a little bit more than made-up incentives.
Yeah, yeah.
From the government, because they're not always fleshed out, and you create malincentives, and you create misinvestment and unintended consequences. And it ends up, what we're describing is like a welfare scheme for developers to make a lot of money.
Well, in the worst case, for
Because
sure.
society needs more housing, and because we have screwed up zoning restrictions and NIMBYism, a culture of NIMBYism, and a culture that gives lip service to property rights, but not really to a degree that's going to solve the problem. Is we've talked about a million times in the show. The only solution is just to build more housing.
Yeah.
Market rate. People say we don't need more. We don't need more A class. Well, yeah. Again, but if we built more A class, again, the effect that has been is rents have actually lowered.
What happens?
And it turns into B. It'll turn into C, and we have more nice places for people to live. The alternative is we build these, and they're not like bad because you get a bunch of money to build them. They may spend all the money on the sign and dumb stuff, and they cheap out elsewhere where they shouldn't, because they're not incentivized to deliver a service for people and to maintain it, because there's no like ownership in it. They're just getting a fee for delivering crap service. So I think a market-based solution would be a preferable one. It's a lot better than it used to be. It's a lot better than when the government built housing projects and managed those and ran those into the ground. So it's better, but we're not there. But we definitely need more housing, and if it comes in through some tax credits, it's better than none. And I hope the folks that get awarded those tax credits and that take on affordable housing have good intentions and aren't just seeing opportunities to pop off on some fees. It could. I hope that people invest in affordable housing and make a ton of money. And deliver some really high quality.
That there's a system that works there.
I don't want you to go make a bunch of money and screw a bunch of people over.
I want it to
that's
make.
what grinds my gears.
And I completely agree. I think there is a system out there. I think that because the government is involved in it, it has to be laid out beforehand, and all these what ifs, and kind of close all the holes that people may find to wriggle out of. But I think people are doing it right. I also think that there's probably ways to spend a lot of money and still do a bad job on it too. Yeah.
Oh, well, don't worry. Kamala Harris or Donald Trump, they'll fix it. Whoever gets it.
A lot of money and a bad job.
That's right. All right, everyone, make sure you subscribe to the Gray Capital YouTube channel so you can get all the latest episodes of the Gray Report, the Complex, and all the videos that the Gray Capital team puts out. You never know. Maybe we'll have a new deal come here soon. That's not necessarily a sneak peek because we don't have a deal right now. But you want to be in the know. You'll hear about it here. But if you sign up for the Gray Report newsletter, you'll have an opportunity for us to reach out to you at some point. If we do get a deal, you have to be a accredited investor to invest with Gray Capital. But that is what we do. We find apartment communities in the Midwest. We're based in Indianapolis. We buy them. We try to buy them for a really good price. Sometimes we were fixing them up. Sometimes we're just managing them better. Typically, we're buying kind of newer, 1995 to newer properties. And we just like to invest with folks that are kind of like us, that like doing good deals, good people. We'll talk about real estate. So thanks for watching this episode. Leave a comment below. What I want to know is, if you've watched the last live stream, you may have noticed a little difference. Matt was you weren't in your suit. You took your jacket off for the episode, but it was looking good.
I thought I did look good in a white button-up shirt and tie.
I thought Matt looked really good.
Right.
I thought everybody looked professional.
Thank you.
And absolutely a good compliment. And I thought the whole office looked really good.
Oh yeah, for sure.
I was tempted, even though because I know
you look really good too.
No, thanks, Matt. But so we did some headshots, a little bit of the photo shoot picture day at the office last week, and I asked everyone was getting ready to wear a jacket and a nice shirt, and I encouraged everybody or told everybody to wear a tie,
Oh yeah,
or at least
I
bring
thought
a
about
tie.
that too.
And I know that it's not as trendy or popular to wear
Hmm.
ties, and it's like a little bit of like, oh, come on. But man, everybody looked good.
I know. I like to
Everybody
put the
looked
tie on
really good.
because when I didn't have a tie, I felt like I was at my old job as a cater waiter freshman year of high school.
Yeah,
So
yeah.
yeah,
No one's gonna look at somebody in a suit and tie and be like, oh wow, they look good.
yeah, yeah,
They'll be like, damn, they look good.
yeah, yeah.
He looks professional.
So
Well, really professional.
next
So
week I'll
maybe I can.
yeah we'll sharpen up.
Yeah, exactly. All right. Well, thanks for watching this episode. Catch you on next week's episode.